Okay, so I think part of what I was driving at was there's a 704B gain loss transaction or transaction that has to be accounted for, and a 704C transaction has to be accounted for. Sam, what's this page say?
Same facts as fact pattern number 2, except the ground's fair market value is 20 grand. Basis in the ground remains at 10K. What's the fair market value? Just ground, 20K. How much has the ground appreciated since the fact pattern existed in fact pattern number 2? 10K. What's Jeff's tax basis in the ground? 10K. If Jeff sold the ground, what's the gain in the ground? 10K.
Okay, what's 5 say?
Pete and Jeff deposited $500 each into a First National Bank account. They agreed to buy land C for $1,000. The ground's fair market value is 20 grand. What's the fair market value of the land? 20,000. What's Jeff and Pete's tax basis in the land? 1,000. Or is it asking? Would it be 500 each or just?
It's combined, 500 each or 1,000.
All right. If the ground was sold, what gain would be generated? 19,000. If the ground was sold, what is Jeff's gain? What is that? 9.5.
9,500, yep.
And then same for question 5.
Okay, so part of this exercise is truly trying to demonstrate that appreciation that occurs post people getting together, which we had up here at 2 million and 1 million, right, is going to be split based on the required allocation versus, the agreed upon allocation, and the inherent gain is going to go with through a required allocation. And Sam, does the required allocation hit the 704B account or 704C account?
C.
C. And that required allocation, does it get the capital accounts more out of whack or does it get them in sync?
In sync.
In sync. So the inherent gain, the required allocation is meant to push the gain to the right person who is the inherent gain contributor when the partnership was put together. Okay? Who you want to call in?
Brett.
Have you been called on at all today?
No.
That's why I called him.
It's good to be Brett.
I was hoping to make it the whole day.
Let's just say, Brett, I'm like, because Stuthman's, I thought you were flying under the radar screen. Son of a bitch. Brett, you've really flown under the radar.
Tried to. Fact pattern number 5 continued. Question 6, what is the process for Pete and Jeff to report the gain? Is there a partnership?
Yeah.
Yes. What gain is reported at the partnership or entity level? If the partnership sold the ground, it would be a $19,000
Yep.
gain. If the gain is reported at the entity level, how is the gain reported to Jeff and Pete? Stated differently, what tax document is provided to Jeff and Pete? They get a K1 that
Yep.
shows they have 1231 gain of 9,500. Good?
Yeah, sure.
Okay.
Does anybody want to disagree with that 1231? Why?
So it depends what you're doing with the land.
Depends on what you're doing with land. I mean, land is always tricky. It could be inventory, 1231, or capital. You have a presumption that it was used in the trader business. What's the definition? 1231?
Used in a trader business held for more than 1 year.
And
Depreciable tangible property.
it could be either real property used in trader business for more than 1 year, or tangible personal property used in a trader business subject to depreciation for more than 1 year. Those are two categories. But anyway, we're splitting hairs. Or Sam is. She was giving me a look. She's the one that made me say it.
Okay. Keep going?
Yeah, please.
The basis in the partnership interest of Jeff and Pete is what amount? Is that before or after the sale?
What number are you on?
6D.
After the sale.
After the sale, 10,000.
10,000. Okay. Go ahead.
Pete and Jeff's basis in the partnership interest post-sale is how much? 10,000.
Yep.
How much cash did Pete and Jeff receive from the sale of land?
10 each.
Did the partnership hold on to it?
It's making the assumption that it was distributed. I like how you're splitting hairs now. I love it.
10,000.
Yeah.
Did the cash received equal the tax basis calculated in 6F above? Yes.
Okay, so this, when I originally did this, this slide was intended to start sniffing at and introducing the concept that there would be an allocation that's for 704B, there's an allocation for 704C, and that those allocations are intended to drive the capital accounts into the same spot. This was really 704-101. Okay? Brett, who you want to call in?
Leslie.
704B capital account. 704B capital account equals the fair market value of property being contributed to a partnership. A, the 704B capital account is a partnership IOU based on fair market value of property being contributed. Stated differently, the 704B capital account is a partner's economic right. 704B capital account is adjusted for division of income, loss, and distribution that occur post-formation. Review the PAC patterns 1 through 5. What is the economic 704B capital assuming the property was contributed to a partnership? So, fact pattern number 1, 704B.
You know what? Here, let's do it this way. That way you guys don't have to. Okay? This is fact pattern number 1. Isn't it?
Yes.
Okay, so what under this fact pattern, what is the 704B capital account?
So that'd be the fair market value of $10,000 at the land that Pete owns.
Yep. Okay,
Yeah.
you go with that? Everybody go with that? What about 2?
So Jeff owning the land with fair market value of 10,000.
Okay, what about 3?
3 is, so when he contributed it, it had a fair market value of $10,000, but now it appreciated to 20,000.
So, but there's an assumption, though, embedded. Did it get contributed to a partnership that's saying, how did I phrase the question? Okay, what is the economic, assuming the property was contributed to a partnership? And you could do this one of 2 ways. The way I would read this is that it's contributed at 20, just based on how I wrote that question, but your 10 is not inappropriate. So your 10 is presuming that it was contributed when it was worth 10 and that there was appreciation of 20, or we just knew it was worth 10 at some point, it appreciated 20, and then it was contributed, which is worth 20. Either is an acceptable answer to me, but it's what is the fair value of that asset when it was at the date it was contributed. Okay?
All right, number 4. So if it was contributed when it was 20,
Yep. Again, I think I was shooting for the appreciated number. 5?
gross fair market value. So fair market value is 20.
Yep. Whoops. Okay. What about, who you want to call in, Leslie?
Let's do Austin.
Rustin? All right, so what's 704C account?
1,000.
1,000? 2?
10,000.
10,000? 3?
1,000.
4?
10,000.
5?
1,000.
Yeah, and 5's confusing because it looks like there's partnership there on top of it. Okay, so in doing the analysis upon the formation of a partnership, you have to know the tax basis of the asset that's being contributed. You have to know the fair value of the asset that's being contributed, and you have to know those items in order to populate the 704B and 704C capital accounts. Is that clear enough to everybody? Okay, so now we're going to take, well, Austin, what's this page say? 1, 2, and 3, and 4.
Number one, why do we quantify the 704B and 704C capital accounts when a partnership is formed? To quantify the inherent gain or loss at the date of formation. Number two, why do we care about the inherent gain at the date of formation? This is very informative in what tax law required special allocations will be. Remember, a tax law required special allocation is very different than agreed to allocations that is set forth in the partnership agreement. How do you quantify the inherent gain at the date of formation? The formula 704B minus 704C equals the inherent gain.
Okay, so what was my 704B capital account, Leslie, for 1, 2, 3, 4, and 5?
I think it was 10-10, 20-20, 20.
Does that sound right to everybody? I can't remember. Austin, what was my 704C?
Do 1,000, 10,000, 1,000, 10,000, and 1,000.
Okay. And what's my inherent gain? Austin calling somebody?
Stu,
9,000, 0, 19,000, 10,000, and 19,000.
Okay. All right, let's see what the next slide says.
How is the inherent gain informative in required special allocations for tax? The inherent gain at the date of contribution is allocated to the partner who contributed the property when the property is sold or transacted upon.
Okay. What's this say, Stu?
Process: determine the properties contributed to the partnership. 2, determine the fair market value of the property being contributed. The fair market value is generally agreed upon by the partners who contributed to the partnership. 3, determine the tax basis of the property contributed to the partnership. 4, construct a 704B, C, and inherent gain balance sheet. 5, build a 704B and 704C capital account. 6, track your 704B and C capital accounts for transactions that occur post-formation. 7, if the 704B and C capital accounts do not equal at the date of the formation, the required special allocation for tax should equalize them.
Okay, so this is how I just formulated in my head what a procedure might be. Might be right, might be wrong, but this is how my brain thinks about how to confront this situation. Okay, determine the property that's contributed. So you have to say, well, what was contributed? And all the previous fact patterns, they happen to be land. In the call I had before, I had hogs, I had depreciable property, and I had partnership interests. So in that call, there were 3 specific items that had inherent gain in them. So it's not always just as simple as land being contributed. Determine the fair market value of the property being contributed. That's something that's negotiated between the people that are doing the contributing. So, Stu, who you want to call in?
Mar.
Who?
Me.
Mar? Oh, he threw that at you, didn't he? Right there. So and this is a skill that I think you guys probably might have, but if you don't, you probably want to develop it, is inferring what value is. And inferring what value is becoming wildly more difficult with waterfalls. It's hard. So if Aaron put in $1 million of cash and I put in a piece of ground and we're 50-50, you can infer the value of my ground is what, Nate?
$1 million.
$1 million. So you're using the guidepost of the cash contributor as what the other value of the assets are. Okay, so determine the fair market value of the property being contributed. The fair market value is generally agreed upon by the partners who contributed it. Okay? Determine the basis of the property being contributed. Fine. Construct a 704B, 704C, and inherent gain balance sheet. What on God's green earth does that mean, Nate?
The 704B balance sheet would be the fair market value balance sheet.
Okay.
704C would be your tax basis balance sheet. And then the inherent gain balance sheet would just be your 704B minus 704C, whatever the differences would be here.
Okay, so far all we've really talked about is 704B and 704C capital accounts, have we not? This balance sheet is kind of a little bit of a new twist on what we're talking about. In the equity section of the 704B and 704C balance sheet is going to equal the 704B and C capital accounts. Your equity section and your 704, in your capital accounts and your equity on the balance sheet, those two are tied completely together. The balance sheet itself, what were the three categories of assets that we're dealing with for 704 purposes?
Short-term realized
Yep.
depreciable assets. and
Yep.
Things that we will sell in the future.
Things we sell in the future. And how do we quantify what those are? We do it by the construction of the 704C, B, and C balance sheet. So we're going to say, for purposes of discussion, that Austin has PP&E, acquisition cost of $1 million, a cum of $1 million, net book value, how much, Austin?
0.
0. Fair market value, well, we'll leave that out for a second. And we have Pete with ground with acquisition cost of $100,000. And we have, let's leave it at that. And we have Aaron, cash of $1 million. And we're going to contribute all these assets. I'm contributing my ground, Austin's contributing his PP&E, and Aaron's contributing his cash for $1 million. Okay, so step one says what up there? Alyssa?
From the property contributed.
We've done that.
Yep.
We did. What's step two say?
Determine the fair market value of the property being contributed.
Okay. What's the fair market value of Austin's equipment?
1 million,
How do you know that?
because that's what the acquisition cost was.
Nope.
Or is that? It's like agreed upon. Is that what you're saying?
Sure. But if Austin and Aaron and I are 1/3, 1/3, is there any information that you can infer what each interest is worth? Brett?
Cash.
Cash. So Aaron contributed $1 million in cash for a 1/3 interest. Would that infer that Pete's interest and Austin's interest are both worth $1 million because we're each getting a third?
Depends. What if Pete's doing a bunch of sweat equity and other stuff too? I
Well,
feel like we see that a lot.
fair enough, but we're going, with respect to just working through this,
Yep.
we're going to push that aside just for a second because the water's going to be muddy enough here in a second.
Okay.
Okay, so we can now say Austin's piece is 1 million of value, correct? And we can say Pete's ground is fair market value, 1 million, correct? Because we infer that based on Aaron's contribution to cash.
Yeah.
Okay?
Yep.
What's the next thing say?
Determine the tax basis of the property contributed to the partnership.
And we gave that to you, right? What's the next thing say?
Construct a 704B, 704C, and an inherent gain balance sheet.
Okay? So one of the skills that we talked about in other classes is how do you construct a fair market value balance? How do we construct a balance sheet? Where do we always start, Stuthman?
The equity section.
The equity section. And taking a step back, what's the accounting equation that you're using to say the equity section?
Well, we know what the
Hold on, just tell me the equation.
assets
Assets.
equals liabilities plus equity.
Okay, so we know, right, that what the equity section is. So we said 704B balance sheet, correct? 704B. We have equity section, because that's where you said that we need to start, correct? So taking a note saying that we always start in the equity section is worth taking a note about, I think, is it not? So we have Austin, Pete, and Aaron, correct? What's Austin's fair market value equity?
They're all million.
They're all $1 million. Okay? Was there any sort of liabilities? Is there any liabilities on this?
Nope.
So liabilities is 0. So liabilities plus equity is how much?
3 million.
3 million. Okay? So what assets were contributed?
The PP&E.
PP&E,
Let's probably start with cash.
cash is fine.
Then land.
Land. And what's the value of those?
They're all million.
1 million. $3 million. Maher, what's my tax basis side look like?
Your tax basis side for equity,
It's fine.
yeah, we're good. And then if we,
Oh, no. For tax basis, what is it? Let's talk about 704C now. What's Austin's tax basis?
0.
0. And what code section tells you that his tax equity is 0? 723? Perfect. Okay. So what's Pete's tax basis?
100,000.
100. What's Aaron's tax basis?
Million.
$1 million. So we have 1.1 million because we have no liabilities, correct?
Yep.
So now we know that this side of the balance sheet is 1.1 million. Basis in the cash,
1 million.
just 1 million. What about the PP&E?
0.
0. What about the land?
100,000.
100K. And our inherent gain is what?
0. 1,900,000. 900,000.
Okay, there's no inherent gain. So Austin's inherent gain is 1 million. Pete's is 900. And Aaron's is 0. So the construction of the balance sheet, the fair value balance sheet, and the tax basis balance sheet tells us that in the equity section, Austin has a pregnant gain of $1 million. Pete has a pregnant gain of 900,000, and Aaron has a pregnant gain of 0. But more importantly, there were 3 kinds of assets, and what were they, Noodles?
They were, like, what did we say? Short-term recognizable,
Short-term recognizable,
depreciable assets,
depreciable
and
assets,
things we will sell in the future.
and things we'll sell in the future. Okay? And now we know that PP&E is one asset, the land is another, and land is only going to generate a required allocation when, Kelsey?
When it's sold.
when it's sold. The depreciable asset's going to generate its required allocation when?
It's sold.
Leslie?
Appreciated.
When it's depreciated. And that by itself, when you go back to the call that we had earlier, I said that there was a depreciation that was associated with the party that put in 50 million, that was $3 million, and then which resulted in the allocation of income to standard of $1 million. Okay, and we're going to get into what that is. But the construction of the balance sheet tells us which partner has the inherent gain. It also tells us which asset has the inherent gain embedded in that asset. And when we know that which asset has the embedded gain and which was the contributing partner, we know who to tie that inherent gain to. And when the land is sold, Noodles, who gets this required allocation?
You,
Me. And when we have depreciation, who gets the required allocation?
Austin.
Austin. You're going to get income, Austin.
Yeah.
This is a deduction. You're going to get income. But it tells us that that's you. So the construction of the balance sheet is very, very, very important for what we're doing. Okay? Shit, we're only on step 4. Okay? Build a 704B and C capital account, which again, the equity section does that. But if we come over here, does everybody understand the capital accounts and what they would look like? Okay. Then what's 6 say? Leslie?
Track your 704B and 704C capital accounts for transactions that occur post-formation.
Okay, and going back to Sam's question earlier, we have the required, or we have the agreed upon, which hits one account, both accounts, neither accounts. Both. We have a required, which hits C only. Okay, and when it talks about track your 704B and your 704C capital accounts, it says which is going to result in a
Recording in progress.
and then 7. What's Sam? 7 say, Sam?
If the 704B and 704C capital accounts do not equal at the date of formation, the required special allocation for tax should equalize them.
Now, we're going to talk about this, but this is worth putting a highlighter on that last piece. And I did hand out highlighters just for such an occasion. The sentence should equalize them isn't always true. Because again, we go back to there's 3 methodologies that exist. One is traditional, second is traditional with curative, and the third is remedial. And the traditional method, and all those 3 methodologies have to do with the depreciable assets. We have those 3 categories. The traditional with curative, and remedial have to do with depreciable assets and how we're going to allocate those deductions. So it's possible that if you choose the traditional method, that while the non-inherent gain partner has an amount that should be allocable to them, an amount for fair value depreciation of $100, there may not be deduction to allocate to them. So even though the fair value capital account says there's a required allocation, it might be that there's not enough deduction to support that allocation and nothing happens for tax. And if that's true, and we're going to demonstrate this, that the required allocation didn't occur by virtue of not having enough deduction, and if it didn't occur by virtue of not having enough deduction, your capital accounts aren't going to equalize. And we're going to demonstrate that.